Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. You're listening to Destination Retirement. Thank you for joining us this Saturday. My name is Robert Kuhn, president, founder of Kuhn Capital Partners. Yes, we're independent. If you've listened to us for any length of time, you know we're all about education. We're about making sure that your portfolio can do well, whether the markets are up, down, or sideways. I want you to understand that you can make money when the markets are down. I think that's the job of an advisor. The job of an advisor is financial planning, of course. Without a doubt, we want a roadmap. We want that roadmap updated quarterly at a minimum. But also we want to make sure that we are providing strategies that can deliver positive returns when the markets are down. So with that said, if you have any questions that you would like to ask me, generally the best way to do that is you can certainly get on the website, kuhncp.com, and there's a contact us button, and you can ask any questions. You can set a time up for my assistant Paige to reach out to you, and she will do that, or you can certainly call her at 630-492-1912. 630-492-1912. So I want to talk about in this first segment, and maybe it'll spill over into segment 2, why recession is no longer a remote risk. I think it's certainly something that we have to explore, we have to plan for, we have to protect against, we have to make sure that we can handle a potential recession, a slowdown, high interest rates. The Fed, it's anybody's guess what is going to happen. I was listening to a show this week, and they said stagflation is the furthest thing from a possibility because the economy is still growing. And, I think you can really make details. You can make statistics, tell any story that you want. And it's an issue that I have with the industry, with advisors, because if you look at it, real inflation, the inflation that you and I deal with on a daily basis is significant. It just is. I don't care what the government says it is. If we look at what you and I deal with on a day-to-day basis, it is the prices are just up, and I don't think they're going down. I was amazed. My son got asked for money for a burrito from Chipotle a week ago, and it was $20, and I had absolutely no clue. That's how out of touch I am with that stuff. But generally, it's my wife that is much more in touch with kind of spend on a monthly basis, and we had a conversation about just the extent of the increases and the cost increases, and so. It's high, and growth is certainly slowing, and it doesn't mean it has to stop. So whether it's stagflation or not, I think, what my biggest concern is, and what we're talking with potential clients with on a daily basis and current clients, is low growth for an extended period of time. And that is something that we have to address. So we do a lot of dual directional banknotes, and we do a lot of income banknotes. And I hear oftentimes from individuals, why doesn't everybody do this? and that's a great question. Why doesn't everybody do it? Why doesn't every financial advisor recommend it? And the answer to that is really simple. When you look at the banknote space, look at where they're done, it's generally done in the private bank space. It's generally done in the high net worth space. And that takes away a lot of advisors' client base. And so they're not going to learn something that may only appeal to a handful of clients. And when I got into the business in the late 90s, and very early on, it was about probably 2002 and 3, we really started to embrace, structured finance or investments that have some sort of a defined outcome. And we were cutting edge at the time. And I still think we're cutting edge because most advisors don't do it. But it certainly is much more mainstream today. But we want to invest, when we look at crafting a portfolio and we look at kind of what we do for clients and for, investors that, call us a partner, is we want to make sure that we have protection, we have growth plus, and then we have tax and alternative. And the protection, we are totally unique in the structured note space. Probably 8 out of 10 advisors do not use bank notes. A lot of reasons why, I mentioned it just a minute ago, was that if you didn't grow up learning that space and incorporating it early on in your career, most advisors just won't learn something new. It's just the facts of the business. And I understand why, but, because again, it's hard for them to incorporate something when they've already, they're already making, 7 figures and they've got a good life. But at the end of the day, it's what's best for the client. It's what is going to give the client the best chance to succeed if the markets go against us. And so I tell individuals, people certainly work with us for our outperformance. When we look at our growth and our growth plus strategies, there's significant outperformance versus the S&P. There just is. It's, we'd love to share it with you, but the way I look at it is that's not changing your lifestyle. If our growth portfolio can outperform the S&P from, on average 2 to 5%, albeit past performance isn't indicative of future results, that certainly is nice outperformance, and it does add up, and it adds up significantly. And then if you look at our growth plus portfolio that we utilize, it's almost doubled what the S&P has done since 2015, almost 700%, versus the S&P up almost 300%. So yes, people work with us for our growth outperformance, but they really should work with us because again, that's not changing your lifestyle. Outperformance is nice without a doubt, but it's not changing your lifestyle. But I think people work with us because of our protection strategies and then our tax strategies and our alternative strategies. Again, if you look at the bank notes, they no longer require a minimum investment of $1 million in a note. That's early, late 90s, early 2000s. Today, it's $1,000. So the notes are for everybody. We just did a bank note, a Morgan Stanley backed income note that pays 13.5% annually. It's paid monthly, and you get that coupon payment as long as the indexes that the note was tracking aren't down 30%. Phenomenal. 13.5% with 30% downside protection to get that coupon. Now, there's a lot more that goes into the note. It's very simplistic, but, if you like 13.5% annually for some protection money with 30% protection on the downside, then let's talk. Let's have that conversation. 630-492-1912. The dual directional banknotes, again, we're still seeing pricing in the neighborhood of 18 to 22% on the upside over 15 months. So you get the first, 18 to 22%, depending upon what the note finally prices at, of the indexes that it follows. Again, we started today. They look at it again in 15 months. So I think you're going to capture 100% of the upside of the market. But you also make money if the market's down. Think about that. Negative 20 is our buffer. So from 0 to negative 20, you are making money. You're making the inverse return. So if the indexes that it's tracking are down 20, well, you're positive 20. So those are the things that we want to talk about. And so when we look at, why recession risk is no longer a remote risk, we've had robust growth, but we've also had stubborn inflation. And I think when you look at a boom and bust scenario for the economy, unfortunately, it looms larger. And that's something that we just have to take into consideration. It's something that we have to plan for. And my philosophy has always been, for our protection money, if we can get above average equity returns for protection money, then we're doing a great job. Because if you look at fixed income, we're in a 4-year drawdown. I want you to hear that. If you're working with an advisor, 99% chance your safe money is in fixed income. How is that done for you? You've lost money, 4-year drawdown, and it's unnecessary. So, when we look at rate hikes and we look at, what is the Fed going to do? We look at growth being what it is. We look at inflation being what it is. we're starting to see the market price in actually rate hikes. But one thing I've learned is you just never know anymore with this market. I mean, the Fed, I just don't know. I mean, they're still saying 2 rate hikes this year. Well, that's down from 6, when at the beginning of the year when the market ran. So it's going to be hard. It's going to be hard, I think, personally, for them to cut rates unless, they're doing it for, political motivations rather than economic motivations. But again, statistics, you can craft any story. And Jerome Powell loves, I personally believe he likes low interest rates. I think he is a dove. So I think they're going to do everything they can to try to cut rates, but it's anybody's guess if that will happen or not. So, I do think, we have seen a delay to Fed rate hikes, and stocks, they have held up, and they've held up well. Really, it's just simply due to solid corporate earnings and optimistic, just expectations of near-term kind of no landing or soft landing economic scenario, whatever that means. But I do think you cannot take out 100% the odds of a hard landing or a stagflation scenario. And I think that has risen to, if you look at a lot of the investment banks and a lot of the research analysts that we follow, some are saying that's a 25 to 30% chance of a hard landing, which is just not a good economics, outcome, or stagflation, which is, again, high inflation and no growth, but call it what you want. Even if you don't hit, the technical definition of stagflation, if growth is low, which I'm concerned that it's going to be over the next 3 to 5 to 7 years, those investors with the buy and hold strategy, if you're working with an advisor that's more concerned about implementing allocations that are easy to implement for them, that's just not okay. And the buy and hold, philosophy for 100% of your money with fixed income as a your buffer for, down markets, I think you're going to be disappointed, and it's just not going to be a good thing. So, if we look at, we do have a widening of economic disparities between companies and households, that, could lead to one of those boom and bust scenarios. And I think that we have to make sure that we're planning for it. And when you look at, kind of tax planning, everybody just paid their taxes, or if you filed an extension, then what that tax bill is ultimately going to be. And if you've listened to the show for any length of time, you understand that the most overlooked area of financial planning is tax planning and tax reduction strategies. And in our alternative space, I mean, had you invested in the energy fund last year, you received almost 90%, let's round up just slightly, but 90% per $100,000 invested, $90,000 tax benefit, tax reduction, active passive income. So if you sold a building, you sold a business, you're a high wage earner, and your advisor's not bringing to the table strategies that can greatly reduce your taxable income, we need to have a conversation. And those distributions we tell investors to target 15 to 20% a year. And the nice thing about those distributions is they're independent of the stock and bond market. So if we are in a low growth environment, the bank notes, especially the income notes like the one we did last week, 13.5%, a Morgan Stanley backed bank note, 13.5% annual, with 30% downside protection for you to get paid that coupon payment. That's 1.12% a month. Again, these are things that we have to bring to the table, especially if we're going into a low growth environment. And this is when you're working with a good advisor. So if we can reduce your taxable income greatly and still with that investment have targeted distributions in the 15 to 20% range, I mean, think about that. We have clients that sold a business and the business was, meaningful. They're looking for ways to limit what they pay the IRS legally. And in the energy space, the tax benefits are dramatic. 90% per 100,000, 90% last year. So $90,000 per $100,000 invested. Again, you can do the math. Put in $1 million, that was $900,000. So, we tell individuals to budget for 75 to 80%. So $75,000 to $80,000. But, that way you're not disappointed if it comes in at 70 or 73 and then we get years like last year where it was 90. So with that being said, give Paige a call, get on my calendar, especially if you've listened for an extended period of time to the radio show. Let's just have a conversation. 630-492-1912, 630-492-1912. More recession risk talk after the break.
When you think of a puzzle, what would you say is the most important piece? A corner? A side piece? I would argue the most important piece of a puzzle is the picture on the box, and the same can be said for your retirement. Robert Kuhn from Kuhn Capital Partners would love to show you your retirement picture. For more information, call 630-492-1912 or visit his website at kuhncp.com.
Welcome back. You're listening to Destination Retirement. I am Robert Kuhn, president and founder of Kuhn Capital Partners. We are a fiduciary registered investment advisory firm. We are independent. Our focus is making sure that we have strategies inside of a client's portfolio, an investor's portfolio, that can do well, whether the markets are up, down, or sideways. Our philosophy has always been protection, growth plus, tax, and alternative. That's when you have a good strategy. When you can point to something inside of your portfolio that will either greatly reduce your taxable income, pay strong double-digit targeted distributions independent of the stock and bond market, or on the protection side, make money if the markets are down to a certain point. It's not too good to be true. I hear it all the time. These are very, in my opinion, basic strategies, very basic strategies in the high net worth space. It's just now in the banknote space, it's only $1,000 per note rather than $1 million per note or $500,000 per note. So we can customize these notes at levels that we just weren't able to do in the past. So give us a call, 630-492-1912, 630-492-1912. Set some time up on my calendar and we can have a conversation. Again, we are financial planning based. I think a financial plan is important. It's very, very important. But you know what? It's not a differentiator. Now, for those advisors that don't do a financial plan, well, then I guess it is a differentiator. But what differentiates us versus probably who you're working with and the other advisors that you definitely hear on the radio, I know that for a fact because I listen to the shows and I know the product mix, is the tax reduction and the protection. What other advisor is going to bring you a strategy that can reduce your taxable income had you invested last year by $90,000 per $100,000 invested? Again, we're not tax advisors. These are very black and white tax benefits in the energy strategy, however, but we always recommend just talk with your tax advisor, just make sure. But again, these are very black and white. They've been done for years. And then what other advisor is going to also bring you strategies that can still do well and produce positive returns when the markets are negative? So if those are two characteristics, and then on the growth side, you want historical outperformance, then we're going to be a good group to talk with. So 630-492-1912. So as you know, my fear is low growth for longer. That is a concern of mine. I think, and it's not just a concern of mine, I think it's a concern of many people, but what has your advisor done to protect you from experiencing low growth? What do you have inside of your portfolio that can still pay double-digit returns, regardless of what goes on in the market? And so those are the things that we want to make sure you're hearing me on. So we have to look at the risks. And I think we have, if you look at today, equity investors have spent most of April, at least, the ones that we talk with, adjusting to the reality that economic growth is proving stronger and inflation is proving stickier than previously expected. And I think what that means for the Federal Reserve is they may keep rates higher for longer. And when we look at, considering that the prospect of interest rate cuts has certainly, it's gone down. And to some, it is surprising that equities have held up actually reasonably well against this backdrop. I mean, if you look at the S&P, the index closed up, it was positive, but you look at the last couple of weeks, we're up, 2.7% ish, only off 3% from late March's all-time high. But I do think that if the Fed cannot cut rates, there is some uncertainty, and uncertainty risk is rising. And the time you plan for that is now. It's not after it happens. And, again, I just am so tired of advisors, just only pitching lifetime guaranteed income annuities. And if you have one, the growth has been so disappointing. I see it. I'm not against annuities. I'm not against protection strategies. I mean, there is a 5-year annuity that is a growth annuity that we actually like. And if you're not having to hedge, if the insurance company is not having to hedge for lifetime income, because these annuities, they're sold, and it's just so crazy. And I hear it nonstop, and it just frustrates me to no end. Well, I get 7% a year guaranteed. No, you don't. I mean, who in the world is going to guarantee 7% a year forever? Maybe for future income, you get 7% growth. That may be. But that has very little to do with has nothing to do with real money. So if you look at these annuities, again, we're not against annuities. So hear me. We're not against annuities. We're against lifetime income annuities if you have a net worth over $250,000, because these lifetime annuities, the income annuities, you are only taking your money out until the account goes to zero. Hear that again. You are only taking your money out until that account goes to zero. And then you're into the insurance company's pockets. Well, actuarially, these insurance companies know they're going to give you just enough growth. They're going to put a governor on the withdrawals, so you're never taking that account to zero. So you are missing out on so much. So here's what I like instead, okay? And it is an annuity. It's really, in my opinion, it's a structured note offered by an insurance company because the hedging is so similar, but call it what you want. 5 years, so it's relatively short term, and there's a lot of people that like this. So yes, you do know your worst year is zero. Very reassuring to a lot of people. On the upside, you get the first 11.5% of the S&P 500 price movement. So you don't get dividends. So the first 11.5%. So if the S&P price is up 5, you get 5. 10, you get 10. 11.5, you get 11.5. If it's up 12, well, you get 11.5. 11.5 for safe money, protection money, is very comforting for many investors out there. One of the nice features, if you do receive a gain in a year, that gain is locked in. So it'll never go back down. So that gain is locked in. So when the markets are down, you don't lose money. You don't lose previous gains. And then when the markets come back up, you don't have to spend gains trying to recoup those market losses. So yes, it is an annuity. It is an index annuity, but it's only tied to the S&P, and it's very short term. I challenge anybody who owns an annuity, who owns a lifetime annuity, if you have more than $250,000 of a net worth of investable assets, I'm going to challenge you that this is much, much better. So if you want to have safe money, and you want it tied to an index that it's not one of these fictitious made-up indexes that are brand new, that look great on paper, that illustrate, and an advisor shows you, oh my gosh, this would have done 16%. Well, okay, really? The index that is tracking was never, it didn't even exist. And so we've just seen massive underperformance. So when you look at lifetime income annuities, and if you have over $250,000, I'm telling you, there are better ways to generate significantly more income. Okay, doesn't mean we don't like annuities. How would you like that 5-year? Many people would like to know. Currently, it's 11.5% of the S&P, not including dividends. a lot of merit to have that as a piece of the pie, maybe as a bond replacement. Bonds are in a 4-year drawdown. So with the uncertainty that we see, markets have priced in virtually zero chance of a recession and nearly 80% probability of a soft landing, which means the economy slows, inflation cools over the next year or so, but there's no real issue. So that, again, is something that we have to talk about. So if you don't have anything in your portfolio currently that can greatly reduce your taxable income, that can deliver positive returns, even in negative markets, those strategies are backed by the largest banks in the world. You know every single one of them. Let's have that conversation. 630-492-1912. 630-492-1912. We're going to talk about the haves and have-nots after the break.
Puzzled by your retirement options? It can be hard to put together a retirement strategy without being able to see the whole picture. Kuhn Capital Partners takes pride in providing comprehensive retirement strategy services to our clients. Our comprehensive services integrate all aspects of our clients' financial picture in a coordinated effort to provide for financial clarity and multi-generational wealth. Visit kuhncp.com or give us a call at 630-492-1912 to schedule a consultation today.
Welcome back. You're listening to Destination Retirement. I am your host, Robert Kuhn, president, founder of Kuhn Capital Partners. We're independent. We're a registered investment advisory firm. And yes, we are a fiduciary. I think everybody should always do what's in the right interest or best interest of the client. But that being said, we are a fiduciary. And again, our job is to make sure that you have strategies inside of your portfolio that can deliver positive returns in negative markets, that can greatly reduce your taxable income. Last year, $90,000 per $100,000 invested in our energy strategy that also has targeted distributions in the 15 to 20% range. If you want to learn more about that and our financial planning capabilities, reach out to Paige. We are headquartered in Naperville, just outside of Chicago. Most people in the Chicago market know exactly where we're at, 59 and 88. Those that are listening to the show outside of Chicago, because we do run in multiple markets, know that we can work with you as well. First way to do that is to get with Paige, 630-492-1912, 630-492-1912. Set some time up to have a conversation with us. We work with investors who have $100,000 and investors who have net worths of 15, 20, 50, 75 million dollars. So our criteria is, if you want to have strategies in place that can make money when the markets are down, you want a planning-based firm, then we're going to be good for you. So let's have a conversation. So back to real quick, I mentioned the haves and have-nots, and I wanted to get into that, in this segment. There has been a shift in our outlook. We believe the economy, like I mentioned, is become more vulnerable to the boom and bust scenario. And I think we have to consider, let's call it the haves. It's something that we talk a lot about. Today it's the outlook for mega capitalization companies and large multinationals, especially those tied to global manufacturing markets and technology. Obviously, I think they're certainly, at least it appears to have brightened. I think if you look at, there has been, global economic surprises. I think, that is something. Commodities certainly are rallying, and global manufacturing. If you look at the Purchasing Managers Index, PMI, certainly has rebounded. And I think that does suggest a pickup in global growth. But is that good for the Fed, right? I mean, are we going back to good news is bad news, or is good news, or is bad news good news? I mean, it's just crazy. But most critical, I think we have to make sure that if the Fed does not cut rates, and that a lot of the gains that we've experienced, are not given back in your portfolios. And that kind of leads me to the have-nots, namely, obviously small businesses. If you read the statistics like I do, there are issues. Unlike their large cap peers, small and mid-sized businesses, they've seen their confidence, their capital spending, it's really sharply reversed, and it's gone down. And it's just something that we have to make sure that we're planning against. So my question to you is, as a listener, when it comes to your portfolio, what's your margin of safety? that's something that we used to talk an awful lot about, margin of safety. And man, I used to spend so much time on it. Candidly, I don't know why I've gotten away from it. Maybe it's just, me, unfortunately not, I don't know why. I can't give you an answer, but margin of safety is so critical because that's the first thing I think about always, no matter what investment I'm looking at personally, is what's my margin of safety? What has to happen for me to lose money? And the deals that I look at, the investment opportunities that I look at, I like to invest in opportunities that have a significant margin of safety. The challenge is that most individuals, and certainly their advisors, they can't give them that margin of safety number. Just look at fixed income, right? For years, fixed income, well, last 4 years, it's been terrible. But from really the mid 80s until really just, probably 5-6 years ago, fixed income has just been bulletproof. It's been super safe. And what is, why has that happened? Well, interest rates have done nothing but go down. Well, that has changed. So if you look at your margin of safety inside of your fixed income portfolio, which every advisor out there is going to tell you that you have to own, we're not against owning safe investments, but I want to own an investment that's not tied to so much or has so much interest rate sensitivity. If I can give you a bank note that can pay 13.5% a year with 30% downside protection, that's backed by one of the largest banks in the world, I mean, that's pretty darn strong. And that note we actually did last week. Going forward, we just priced another one. It's around 12 to 12.5%. Again, that's really interesting for safe money. So when we look at your portfolio, I do want you to think of what is your margin of safety. And if you don't know, then we have to talk. 630-492-1912, 630-492-1912. So give Paige a call and she'll certainly set some time up. We've got a few minutes left in this segment. I want to talk about financially smart ways to take money out of retirement accounts. And again, generally the topics that I want to talk about are topics that I see throughout the week and just gives me an idea of what we need to talk about, because many individuals talk about Roth conversions, advisors, that is. That's really simple. I mean, anybody can do a Roth conversion. You don't need an advisor to do that. But what if we can take it to the next level, the PhD level of that Roth conversion, and you don't have to pay any tax on that additional income? Or maybe we can reduce your tax liability on that conversion by 80 to 90%. So four smart ways to take money out of retirement accounts. It's more and more what we're hearing and we're talking about. I don't know if hopefully you heard that the president currently said he wants capital gains rates to go to 44%. It's like, is this political? Is this, I mean, I don't see how that can be a good thing, but it's not for me to say whether something's good or bad. It's for me to say, how do I protect my clients if that does come to fruition? Those are the things that we have to make sure that we are planning for our clients. And so there's many clients that want to take money out of qualified accounts. Generally, when you turn 73, the IRS requires you to take a required minimum distribution from tax qualified retirement accounts. Many people are doing that currently. If you don't need to take RMDs right away, you really should consider using those funds to contribute to possibly loved ones' education, donate to charity. I mean, there are many things that we can do with that money, and especially with those RMDs. But if you are approaching retirement, or if you are currently taking RMDs, or if RMDs are on the horizon, a lot of times for many retirees, that's not welcome news. The extra income you get from the distributions both creates a tax drag on your portfolio's growth, and it potentially could push you into a higher taxed marginal rate. And those are the things that we have to make sure that we're planning against. So what we're doing a lot of, and again, when you look at financial planning, when we look at what is available for that, $1 million to $10 million client of investable assets, or if you're nearing, that $1 million mark, or if you make, a couple $100,000, $300,000, $400,000, $500,000 of income a year, you have and you are afforded accreditation status. That just means you can invest in different investments than the masses. And I think that's unfortunate, because I think everybody needs help, but that's not my rules. But when you look at taking money out of qualified accounts, we have to limit that tax, because $1 out of a qualified account, you're going to be taxed at ordinary income rates on that distribution. If you convert a Roth, an IRA to a Roth, all of that conversion is going to be taxed as ordinary income in the year you do the conversion. So that a lot of times is an issue. Well, what if we can invest that money in a strategy that can greatly reduce your taxable income? So if you're in your 70s, if you're in your 60s, if you're in your 80s, and you want to take that money out, especially if tax rates are going up, you want to take that money out of the qualified state. Well, the government wants their taxes. That's why it's taxed as ordinary income. That doesn't mean that you can't invest it in strategies that provide significant tax benefits. Well, the energy strategy that we utilize does. I mean, last year it was 90%, $90,000 per $100,000 invested, just under 90. I'm rounding up very, very slightly, but for simple math. So think about that, 90,000 per $100,000. It reduced your active passive income. Capital gains doesn't matter. And the investment pays a targeted distribution in the 15-20% range, even if it paid 5%, if it paid 10%, and you get those tax benefits, it's still significant. So think about this. What if you took some money out of your qualified accounts, your IRAs, and you invest, because that money hits your checking account. So you take out $100,000, take out $200,000 for simple math. Let's just use $100,000. Take $100,000 distribution from your IRA. Well, that's $100,000 of additional income that's going to be taxed at ordinary income tax rates. Well, if you invested that $100,000 last year in our energy strategy, well, you reduced that additional income by $90,000. So now you took $100,000 out, but you were only taxed as if you took $10,000 out. Talk about a tax efficient way to get that money out of a qualified state and put it while greatly reducing that additional tax due. And oh, by the way, invest it in a strategy that has targeted distributions in the 15 to 20% range. Again, even if there are 5 to 10% targeted distributions, the tax benefits alone, really require significant consideration. So those are the things that a good advisor does. Those are the things that advisors do. When you are independent, when you are a fiduciary, you have access to strategies like that. If you're working with a big bank, if you're at a big brokerage firm, if you're at a quote unquote independent firm, you're still working with, and it's not truly independent. I mean, that is absolutely not truly independent. There still is a brokerage firm attached to it. Those investments are going to be limited to you because they generally, to get shelf space at a big bank or a big brokerage firm or a big independent firm, you have to give up a lot of revenue to the company to get on their shelf, so their advisors can offer those strategies to you. In many instances, it can be 3%, it can be 10%. It's significant. In certain strategies, like the tax strategy that we have access to, that we utilize, we don't need to pay that. There's plenty of people that want that strategy. So why give up all that revenue? Give that revenue to the client. Save that client. So and it kind of leads me into the Roth conversion story, right? I mean, a Roth, you don't pay taxes, at least today, on the gains. 5 years generally is the only requirement. So a lot of individuals are looking at, and every advisor will tell you to convert that IRA. Well, they'll look at talking about converting the IRA to a Roth. Well, in a lot of instances, I mean, mathematically, I don't know if it makes sense or not. And that's counterintuitive to what a lot of advisors are going to tell you, because if you can't take, and pay those taxes from other investments, well, there's a big chunk of money that's coming out of the account. And we have to look at time. We have to look at assumed growth rates to make sure it does make sense. But here's one way that I'm very, very certain it makes sense. Is if you have other taxable investments that you can then invest in the energy strategy to reduce some or all or 90% or 80% of that additional tax, well, then guess what? Now, all of a sudden, it makes a ton of sense. So we're going to put a mad blitz on this strategy. 630-492-1912, 630-492-1912, because commodities are going up. Oil and gas prices, I mean, they're just higher. And if we have global growth, they're going to continue to at least stay where they're at or go higher. And when you look at investing in energy, I see all of the energy funds out there, not all, but at least the ones that are marketed. And they're always a single well, 2 wells, tier 2, tier 3 location, mom and pop operator. And that's just outside of my risk comfort zone. But that's what 90% of the funds are. 95% of the funds are out there. And that's why oil and gas investing has typically has been thought of as super aggressive. And if that's your strategy, then yes, that is super aggressive, where you either hit a home run, grand slam, or you strike out. Now you get the tax benefits, but again, I look at margin of safety. What is our margin of safety? And the strategy that we use is significantly diversified. They're the best operators in the world: Exxon, Chevron, BP, Occidental, ConocoPhillips, Matador. I mean, these are the best of the best operators. And more importantly, it's in the best zip codes in the United States, possibly in the world. The Permian Basin, West Texas, 65% of domestic production comes from the Permian. Think about that. It is the core of the core. So it does not get any better. So if you're comfortable with only, and I say only because the average investor will laugh when I say only 15 to 20% targeted distributions. I mean, you tell an oil guy that probably doesn't get him too excited. You know, they're looking for 40, 50, 60, 70% a year. Well, with that comes risk. So with our strategy, there's a higher level of predictability, given the operators have the bulk of the money in the deal. So it's, you know, the deal we did last year that gave, end of last year, that gave such significant tax benefits. The operator was a publicly traded company that most people know. I mean, they had 98% of the money in the deal, so close to $100 million. And again, we were only talking about 6 wells, but this isn't a science experiment. I mean, this is in the core of the core. I mean, it's not if, it's just they know the commodities in the ground. And so these are the strategies that it's my job to educate you on. It's anybody can tell you do a Roth conversion. My job is to take it that next step. Well, how can we mitigate that conversion, additional tax on that income you're going to be taxed at in that year? Or if you are over 60 and you have a significant amount of money in your IRA, let's consider taking distributions, and let's consider investing that money in an energy strategy that can give you above average targeted distributions, but can greatly reduce that taxable income. You know, those are the things that we're doing. So we do dinners throughout Chicago. Many people know that. Generally, we do them at Morton's, free advertising for Morton's. They're just in the right areas where the targeted demographic for this type of an investment is prevalent. Our next dinners are the second week of June. I don't have the dates off the top of my head. Just look at the calendar. Second week of June, they're going to be in Naperville, and it's going to be Tuesday and Wednesday. So whatever those dates are, Tuesday and Wednesday in Naperville. So again, if you have a $1 million net worth, not including your primary residence, or you make a few $100,000 of income, or 300,000, I think, is the accreditation jointly, then you do qualify for that. Again, it's not my qualification; it's the SEC's qualification. Then reach out to us and get on that calendar to either come to the dinner or to have a conversation with me. So 630-492-1912, 630-492-1912. When we come back, let's talk more about the growth bucket, the growth plus bucket, and the protection bucket. So give Paige a call, 630-492-1912, to set some time up on my calendar.
Perhaps the most impactful piece of preparing for retirement is determining your current and future tax liability and developing strategies to minimize the amount of taxes you pay in retirement. Tax planning can have a large impact on your wealth and the kind of legacy you will be able to leave. At Kuhn Capital Partners, we provide you with a retirement strategy that can help you minimize taxes in retirement. and take advantage of the 2024 tax rules. Visit CoonCP.com or call our office at 630-492-1912 to get started today.
Welcome back. You're listening to Destination Retirement. Hopefully everybody has had a great Saturday, and hopefully everybody's having a great weekend. And my job is to make sure that I'm giving you some nuggets to think about. That's how I view what it is that I do every day, is to challenge the status quo, challenge the status quo of what advisors are telling you, of what advisors are sharing with you, how they're constructing your portfolios. I really want you to think about this. We're a fiduciary, we're independent, we're a registered investment advisory firm. So yes, we are all of the right credentials to provide fiduciary advice. I want you to think about your portfolio, and I want to know if you can point to a percentage, an allocation of your portfolio, a sleeve, a bucket, call it whatever you want, that you know you can make money if the markets are down. If that is not something that you can point to, then let's have a conversation. 630-492-1912. 630-492-1912. Call Paige, get with her, get some time on my calendar. Let's have a discovery call. Let's learn about what you're doing, what you're not doing, what you like, what you don't like, what your fears are, what your concerns are, and really come down to, yes, having a financial plan, but most importantly, making sure that your portfolio can deliver returns in negative markets, slow growth markets, high inflationary markets. That's what we need to do. That's the role of an advisor. So if you can't point to something, let's have that conversation. 630-492-1912. And why is that? Well, we as advisors are typically have two types of advisors out there. The ones that are going to scare you to death and tell you the market's coming to an end and you have to protect the money and not really grow it, i.e. put it into a lifetime guaranteed annuity with 7% growth is what they're going to tell you. That's not actually your money. It's only income numbers. And if, when we look at, if you listen to any radio show, financial talk, generally 8 out of 10 are going to be annuity based, but they're not going to just come out and say it. But they all pitch these lifetime guaranteed annuities. And I'm going to become aggressive about this. If you have a lifetime income annuity and you have over $250,000 of investable assets, I want to ask you why. Do you understand that the growth is limited? I don't care what the illustrations show you. We'll decipher those illustrations in a second, and I'll show you that index didn't even exist when they showed you that illustration, so it's all back-tested, hypothetical gobbledygook. But think about this. You are only taking your own money out until that account goes to zero. When the account goes to zero, then you're in the insurance company's pockets. Actuarially, they give you just enough growth. They limit your distributions, your annual income, so they know that account's not going to zero. So you're giving up so much for that peace of mind. You can get that peace of mind in other ways with significantly higher distribution rates, in my opinion. Again, we're not against annuities, okay? I love the 5-year index annuity that we talk an awful lot about. In my opinion, if you have over $250,000 of investable assets, it's better than any guaranteed lifetime income strategy you're going to find. So yes, 5 years, very short term. Currently, you get the first 11.5% of the S&P 500 price movement, not including dividends. Still, that's pretty significant. When you get a gain, that gain's locked in, never to go back down. So I do love that feature. Then when the markets grow again, you're not using those gains to recoup future losses. If you look at a 10.5% tied to the S&P cap, you beat the S&P 10 out of 15 years. That is significant. So am I against annuities? Absolutely not. Do I love that 5-year one? Absolutely, for your protection money. It's not equity money, albeit the returns could get close to equity money, but we're not buying it for equity replacement. We're buying it for the fact that the U.S. bond market has now been in a drawdown for 45 months, by far the longest bond bear market in history. But I bet your advisor didn't tell you that. I bet your advisor didn't say we need to shift that bond money to something else that doesn't have that risk interest rate sensitivity. So I don't know why I got on that tangent, but I'm tired of these lifetime income annuities and people just not knowing what they own. Again, it's for you to decide, but it's for me to give you the exact why you would do it and why you wouldn't do it. So there's a place under $250,000 of investable assets total. Maybe it's the best solution known to man. Over $250,000, let's look at repositioning that money into something else, because it's going to, in my opinion, deliver significantly greater returns long term, especially with these lifetime annuities. Now, they tell you the income can go up. It'll never go up, but they tell you that because it can, but it never will. So think about that. What happens if inflation continues to go higher? My goodness, that is going to be just a big drag on your investment. So you can't say we're against annuities, because we like that index annuity at 5 years. Short term, very predictable, tied to the S&P. I know exactly what it is. And you know what? Yes, it's beaten the S&P 10 out of the last 15 years. So, because, I am concerned there. And how did I even get down this path? But, it was going with the two types of advisors, the negative ones and then the ones that only see everything's, a positive. It doesn't matter that, Dollar Tree is closing 600 stores this year. CVS is closing 900 stores through the end of the year. Walgreens is closing 150 stores. Outback Steakhouse has already closed 40 of its restaurants. UPS is cutting 12,000 jobs. Citigroup cutting 20,000 jobs. eBay, thousands of jobs lost. Microsoft cutting 1,900 jobs. I mean, the list goes on and on and on. But yet, the market's going to be fine. Don't worry about it. Buy and hold. Look at it 3 to 5 to 7 to 10 years. It's going to be higher. Well, I don't know about that. If you had bought Microsoft in 2000, it took you 14 years to get back to even. Hear me. 14 years to get back to even. I don't care what happened yesterday. We have to look at the market as forward looking. What got you to where you're at doesn't mean it's going to get you to where you want to be. But again, it's easy for the advisor to sell. It's easy for the advisor to implement. It's easier for the advisor to scale their income. We're not about that. If we educate like we do, I'll make plenty. I'm not worried about my income. It's plenty. My job, even if it takes, like we talk a lot about the banknotes, those are incredibly time consuming to implement. They get called away often. It is very, very time consuming piece of our business. But you know what? So what? It's great for you. It's great for the client. 630-492-1912. 630-492-1912. Every time we talk about the dual directional banknote, the last one we did was the JP Morgan. So it's JP Morgan paper. All the notes are bonds from the bank, senior unsecured debt. So it has a CUSIP. It's just backed by the bank. It's just a bond like you've never heard of. But that dual directional banknote, every time I tell somebody this, they're like, why in the world isn't everybody doing this? Especially for some of your equity money today. I challenge everybody to have some of this in your portfolio. Take some equity investments off the table. Put it in a strategy like this that can still give you probably 100% of the upside that you would have gotten anyways, but will give you that ability to make money if the markets are down. Again, what you think is too good to be true, what I think is too good to be true, it's irrelevant. It doesn't matter, because if you believe in the bank, it's a senior unsecured debt of the bank. It has a CUSIP. It's a bond of the bank. Again, I just can't hit this enough. The thing is, it doesn't charge, there's no commission. So it's just an annual fee, which is why I think a lot of advisors don't do it, especially the annuity pushers out there. They just want that 5 to 9% annuity commission one time, which I think is an issue. But that is, a topic for another day. But I want to really stress that if you want to make money when the markets are down, we are the group to go to. If you want to reduce your taxable income, your distributions of your IRAs, and you want to invest in a strategy that can greatly reduce your taxable income, we are the group to go to. I don't know if there's another advisory group, possibly in the state of Illinois, maybe even in the Midwest, that can give you both of those strategies. Now, 8 out of 10 will do the banknotes, or won't do the banknotes. So there are some people that do banknotes. Those, again, we do it in bulk, so our pricing is probably going to be better than theirs. but there's very few, I don't know any that can give you those tax benefits and then, invest in an energy with a targeted distribution of 15 to 20% annualized. So with that being said, hopefully you learned something this week. If you did and you want to have a conversation, it's really simple. Give Paige a call, 630-492-1912, 630-492-1912. Set some time up on my calendar. Visit the website if you want to set your meeting up that way. Then she can reach out to you. That's KUHNCP.com. Until next week, make it a great week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.